it would be helpful to kind of just like go through not like the entire history of Sailor, but he starts with this kind of dead software company. I'm assuming he does kind of like at the market issuance of equity. He gets bigger and bigger, and then he eventually taps the convertible debt market. Like maybe just like a little bit of his path, and then I guess one question that I had at least is when are you big enough to actually tap the convertible debt market, and maybe like some commentary around how that was initially received and how it's evolved would be great.
Yeah, great question. I think there's like levels to how you get your equity to be valuable beyond the price action, which is that you have to build like an ecosystem of liquidity and a thriving options chain and a variety of like multiplayer dynamics to bring some energy to the stock beyond like just being valuable from a market cap perspective. And so that takes time. I think that's why Saylor, for the most part, is the leader in the space because he's been around the longest to create some of that durable moat for the liquidity provisioning that has been very hard to replicate without that first mover advantage. Um, and also to the context of the credit market, today we take for granted that most and actually all of Saylor's convertible debt are issued at 0% coupon from a cash interest perspective, but that's
Mhm.
not true from its history. In its original history, when it first tapped the credit market, they were cash paid interest rates. In fact, he used to have this subsidiary called Macro Strategy as part of the
Mm.
entity that would hold Bitcoin. And it was not actually part of MicroStrategy and it was ring fenced. That's all changed, of course, in the way that MicroStrategy has grown up to fully become a Bitcoin native treasury operation and company. But you're asking the right questions, Vance, as to like how do these evolutions happen, and at what are the kind of parameters in which these things are permitted. I think for the credit market in particular, uh, there's a certain size for issuances that makes it meaningful for institutional investors. And from my experience of having been a credit investor before joining Bitwise, the difference between 250 as an issuance and above is a pretty material level from a threshold perspective. And if you want to imagine issuing 250 million or so, where the debt to equity ratio is manageable for what is otherwise a Bitcoin operation, you'd have to imagine the market cap has to grow to a certain level for that to be permissible. And to date, I think strategy has generally wanted that debt leverage to be very low, right? Somewhere in the 10% range, maybe a little bit higher, but really not your typical debt to equity ratio of like most corporates that access the credit market. Some of it, I think, is endogenously driven by Saylor not wanting to overextend. But I would also imagine the other side is that the convert market too doesn't want to actually tap into a leverage profile where they would actually be at risk. And you want to account for the volatility of Bitcoin's historic drawdown to 80%, for which some of that debt to equity ratio can be informed. Um, I think the amazing thing is, nonetheless, Saylor has been able to retire those old legacy issuances and has now fully transformed into tapping the convert markets to his advantage with 0% cash interest rate. And that has actually ventured into a new frontier by accessing what historically has been a very, very boring, what I call like the armpit of corporate securities, the preferred market. And is trying to make it into a much more vibrant ecosystem through now I think he has over four different types of pref equity instruments since the beginning of this year. And that has never been done before. Pref equity is generally not accessed by retail investors. They don't have a shelf registration. They don't have tickers. And we have to give Saylor some credit for bringing upon an era of new financialization where pref equity is becoming cool again, sexy again, with retail investors finding that to be a worthwhile endeavor.
Just one last question. So he starts with like these ATMs. He's like selling just like normal shares, as he's kind of in whatever year he started buying Bitcoin at like 13,000, and then he does the converts after he's like big enough, and now he's kind of gone back to equity, but it's like differently constructed versions of equity that kind of look a little bit like debt. Is that right?
Yeah, that's right. That's right. So I think what Saylor unlocked, either intentionally or unintentionally, is that convert investors have a very different motivation to playing the game. And some of it is that the entire business of convertible arbitrage is founded upon extracting value from very high volatility that can be mispriced. And because MicroStrategy is such a volatile stock based upon, of course, its holdings of Bitcoin itself being very volatile, he was able to give convert investors a kind of an absolute yield that historically is not possible without very high undue volatility. Usually, when the undue volatility is as high, it's because the company is at default risk. And so, as a lender, you almost never want to touch it. But here, the reflexive thing being if the volatility is coming from pristine collateral, which in itself is a collateral for lenders to feel comfort around, you get the best of both worlds. You get high volatility, but you also get this asset backed credit like profile and having collateral for liquidation. So, very unique phenomenon. He taps into it and then quickly finds out that this alignment is actually really good for equity, which is that converts are happy to uh, become equity at a much higher price, hence having coined the term accretive dilution around this construct, for which they are able to give equity investors an equally worthwhile push for the monetization of its volatility. At the same time, I think what sailors realized is there are sometimes adversarial market dynamics that can arise out of these participants. So, for example, let's say you're a convert investor, right? That means you're basically long a call option on MicroStrategy that is way out of the money. And if you were to basically hedge that exposure every day from a market neutral perspective of monetizing that gamma, you're essentially going to go out and create dynamics that lead to mean reversion in the stock price. So meaning, let's say I'm long this call option and stock price goes up a lot. So my delta gets really high. Let's say my delta went from 10 delta to 30 delta with a gamma. So now I'm really long the stock. You as a convert manager, you have to go sell the stock now to flatten that risk out. So what that means is as the stock price goes up, you're counteracting that dynamic by selling stock into the market, therefore reducing its upward momentum. And the effect is the same the other way around. If the stock goes down and your delta is going down, you as the convert manager have to buy back the stock. This is called long gamma hedging. And long gamma hedging historically mutes volatility. And so once you become big enough, that trading activity in itself can be a volatility impediment. And that I think is what Saylor has also realized. If you make convert investors too big of your market participants, they can also mute volatility, which is the exact opposite of the outcome you want to achieve. And so there is a delicate balance at how much convert investors you want in the ecosystem, thriving alongside other investors in the pool.